Welcome to this explainer. Ever look at a stock market chart and feel like you're just staring at a totally chaotic mess of jagged lines? You definitely aren't alone. Most people look at it and just see a heart monitor going completely haywire. But what if I told you that hidden right inside all that seemingly random noise is a profound, highly structured, and entirely predictable pattern? Today, we're going to explore the Elliott Wave principle. It's this incredible framework that reveals how the stock market actually isn't a random walk at all. Instead, it's a direct reflection of the predictable, repetitive nature of human psychology. Okay, let's jump right in. Check out this idea from the legendary multimillionaire investor, Bernard Baruch. It perfectly sets up our foundational philosophy today. You see, the market isn't fundamentally driven by random news events or corporate earnings or even presidential elections. What really drives the market is how masses of people react to those things. It's the predictable, repetitive nature of mass human emotion, constantly swinging back and forth from extreme optimism to extreme pessimism. So that begs a pretty massive question. If the market is essentially just a giant mirror reflecting our collective human psychology, does that psychology leave behind a predictable footprint? Like, can we actually map it out? Well, that is exactly the core mystery we're going to solve for you in this explainer today. Here is our roadmap for the explainer. We'll start off by uncovering the market's hidden pattern. Then we'll learn a bit about the man behind the theory, R.N. Elliott. After that, we'll break down the mechanics of the basic 5-3 wave, explore the fractal nature of markets, dig into the fascinating math behind it all, and finally wrap up with why this actually matters for you today. Let's get to it. All right, first up, the market's hidden pattern. It's all about the psychology of crowds. Here is the core tenet you absolutely have to grasp. Market movement reflects a repetition of forms that is totally independent of presumed causal events. Meaning, instead of looking at a shocking news headline and just assuming it caused a market crash or a massive rally, we have to recognize that the market actually unfolds in these predictable, directional patterns called waves. And these waves, they're governed by our fundamental social nature. They happen regardless of whatever the daily news cycle throws at us. So where did this idea even come from? Let's talk about the man who figured this all out from the comfort of a rocking chair, R.N. Elliott. Back in the early 1900s, Charles Down noticed that markets move in orderly, repetitious swings. But honestly, he was painting with very broad strokes. Fast forward to the 1930s, we meet a man named Ralph Nelson Elliott living in California. He's forced into retirement, totally confined to a rocking chair because of a debilitating illness. To pass the time and keep his mind sharp, he basically begins obsessively studying hourly, daily, and weekly charts of the Dow Jones averages. And right from that rocking chair, he discovers that these market movements follow incredibly precise, detailed wave patterns. Decades later, in 1978, A.J. Frost and Robert Prechter published the definitive textbook on his findings, and that book is actually the source material for our explainer today. Okay, let's get into the actual mechanics, the basic 5-3 wave, which is split into motive and corrective phases. Elliott essentially saw two very distinct modes of market movement. First up is the motive wave. This is a 5-wave structure that powerfully pushes the market in the direction of the larger primary trend. The second is the corrective wave. Now, this is a 3-wave structure that acts as a counter-trend interruption. To make it simple, think of the motive wave as the car engine, powerfully moving you forward, and the corrective wave as a temporary pit stop, or maybe a brief step backward to refuel. Taking a look at this, you can see exactly what we just defined. Notice how the basic motive pattern has 5 specific waves. Waves 1, 3, and 5 are the ones actually affecting the directional movement. They're doing the hard work, pushing the market higher in a bold trend. Meanwhile, waves 2 and 4 are simply counter-trend interruptions. They don't change the overall upward trajectory. They just pause it to catch a breath before the next thrust upward. Now, what happens when we take that 5-wave motive phase and link it directly with a 3-wave corrective phase? Check out the right side here, labeled A, B, and C. This forms one complete 8-wave market cycle, 5 waves up, 3 waves down. According to the wave principle, this right here is the fundamental building block of literally all market movement. Which brings us to a concept that is absolutely mind-blowing: the fractal nature of markets. So what exactly happens after that 8-wave cycle finishes? Well, it doesn't just end there. It actually builds into something much, much bigger through compound construction. An initial 8-wave cycle ends, and then a similar one follows right after it. Together, these smaller cycles link up to produce a larger 5-wave pattern. And then, that massive larger pattern is eventually corrected by a sweeping 3-wave pattern of the exact same scale. Basically, the smaller market movements nest absolutely perfectly inside larger generational trends.
You can see this fractal concept visually right here. If you were to put the market under a microscope, you'd find that the tiny subwaves take on the exact same structural form as the massive overarching waves. Look closely at wave 1 circled near the top left. It is entirely composed of its own mini 5-wave motive sequence. And wave 2 right next to it? Yep, it's made up of its own mini ABC correction. It's waves within waves within waves.
And when you zoom out even further, the complexity is just stunning. Seeing the complete market cycle at multiple degrees of scale almost looks like the sprawling branches of a giant oak tree. But the absolute crucial point to remember here is that the form, the degree, and the relative direction remain remarkably constant at any scale. Whether you're looking at a microscopic hourly chart or a massive chart spanning 2 whole centuries, that 5-3 pattern holds true. All right, time to look under the hood. Let's talk about the math behind these waves and a little something called the Fibonacci Connection. Now, here's the mathematical proof that ties Elliott's observations of social psychology directly to the underlying laws of nature. Just look at the number of waves at each degree. At the very largest scale, it's 1 and 1, making 2. Subdivide that, and you get 5 and 3, making 8. Subdivide again, you get 21 and 13, making 34. Then 89 and 55, making 144. Does that sequence ring a bell? 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144. That is the exact mathematical sequence discovered by the 13th century mathematician Leonardo Fibonacci. It turns out the stock market structure literally grows according to the exact same mathematical laws that govern the spirals of a seashell or the branches of a tree. Pretty wild, right? Now, you're probably wondering, why exactly a 5-3 pattern? Why not 7 and 4 or 6 and 2? Well, Elliott noted that the 5-3 pattern is the absolute minimum requirement for, and frankly, the most efficient method of achieving both fluctuation and progress. Think about it. If you just had one continuous wave, there'd be 0 fluctuation. If you had 3 waves forward and 3 waves back, you'd constantly end up exactly where you started. To actually make progress in one direction, despite periods of regression, your movements have to be at least 5 waves forward to cover more ground than your intervening 3 waves backward. It's quite literally nature's most efficient path for growth. So let's bring this all back down to earth. Why does this matter today? How gives us context for market analysis? As Frost and Prechter write, the primary value of the wave principle is that it provides a context for market analysis. It gives us a basis for disciplined thinking and a solid perspective on the market's general position. Sure, some traders out there try to use this for pinpoint, minute-by-minute forecasting, but its true, undeniable genius lies in showing us exactly where we are in the broader behavioral continuum. It functions as an incredibly reliable, big-picture map of human psychology. So, what's our big takeaway from all of this? Basically, the stock market is not a random, chaotic machine. It's actually driven by repeating patterns of mass human psychology. When the market makes progress, it unfolds in those 5-wave motive trends. When it regresses, it unfolds in 3-wave corrective interruptions. And remember, these forms are entirely self-similar and fractal across literally any time scale, organically building into the Fibonacci sequence. Ultimately, understanding this framework completely reframes how we view economic history. It grounds us, providing a highly disciplined perspective during those seemingly chaotic times. Which leaves me with just one final thought for you. Now that you know about the hidden mathematical poetry of human behavior that's quietly dictating the financial markets, will you ever look at a stock chart, or even a crowd of people for that matter, the same way again? The hidden order of the world is right there in front of us, once we just learn how to read the waves. Thank you so much for joining me on this explainer. Catch you next time.